All right, so this question is about loss limitations. Okay, so let's see what we got. So we've got the beginning of 2021, and Jamal's basis in his S Corporation stock was $27,000, and he's directly loaned the S Corporation $10,000. All right, so remember that in general, liabilities do not increase your basis in an S Corporation. However, he directly loaned the S Corporation $10,000, so this $10,000 is his debt basis, okay? So during 2021, the S Corporation reported an $80,000 ordinary business loss and no separately stated items. How much of the loss is deductible by Jamal if he owns 50% of the S Corporation? Okay, so if he owns 50% of the S Corporation, the most he could potentially, if he wasn't limited by basis, the most he could deduct would be 50% of 80 is 40,000. If he was not limited by his basis. However, he might be limited by his basis, okay? And so what is his basis? Well, his basis is 27,000 plus his $10,000 debt basis. So he's limited to $37,000 of a loss deduction, okay? Now, that means that he has a $3,000 suspended loss, okay? Now that suspended loss, it should be noted, it's an indefinite carry forward for that suspended loss, right? However, if they never increase their basis prior to selling their stock in this S Corporation, then that suspended loss will expire unused. Okay. All right, so this is a follow-on problem to our last one. So let's see what we got. So at the beginning of 2021, Jamal's basis was $27,000. We know that. And he directly loaned $10,000. So that was his debt basis. He reported $80,000 ordinary business loss and no separately stated items. After the loss deductions this year, what is his stock and debt basis at the end of the year if he's a 50% shareholder? Okay. So, well, we know that A is not correct. Okay. 0 stock basis and a $10,000, no, because remember that half of that 80 was $40,000, and remember that was his share of the loss. He had a $37,000 combined basis, and we used it all up because we had a $3,000 suspended loss, so we know that's not right. We know that's not right. We know you can't go negative. Okay, so none of these are correct. Okay. And so what he has is a 0 stock basis and a 0 debt basis and a $3,000 suspended loss. Okay. All right, so now we're back to Jamal. So let's see what Jamal's got going on now. So now we've got a stock basis of 0. He also has a 0 debt basis, okay? And he has a $5,000 suspended loss, okay? So in 2021, he contributed $8,000 to the S Corporation, and the S Corporation had $4,000 of income, okay? And Jamal owns 40% of the S Corporation. How much net income or loss does Jamal report this year from the S Corporation, okay? Well, let's look at what we've got. So the S Corporation made $4,000, right? But Jamal is a 40% shareholder. So his share of that income is $16,000, okay? Now remember, he has this $5,000 suspended loss, all right? His stock basis and his debt basis at the beginning of the year were 0. But remember that he contributed $8,000 during 2021, okay? So because he contributed this $8,000, he can deduct his suspended loss, okay? So what that gives him then, if I can get my pen back up here, what that gives him then is a $3,400 loss, okay? And he gets to deduct that loss, so that loss flows through to him. Okay? Because he had contributed that $8,000 and he had enough debt basis to cover it. Okay, so this question is asking us about the loss limitation rules, okay? And they have, so S corporations have loss limitation rules similar to partnerships. For an S corporation shareholder to deduct the loss has to meet 3 different tests, essentially, and they're applied in a particular order, okay? So it has to meet tax basis rules first, then at risk, and then passive activities, okay? And we know that we're not allowed to deduct excess business losses as an S Corp shareholder. Excuse me. So the basis rules are applied first, then the at-risk rules, then the passive loss rules, okay? So the answer to this question is A. This question deals with what's called a short tax year, okay? So remember that S corporations, because they can be terminated voluntarily or involuntarily, they frequently create this thing called a short tax year, okay? So that means a tax year that's less than 12 months, all right? So you can have, so essentially you're gonna have a short S Corp year and a short C Corp year, okay? So you're going to have a short year for both, okay? So what they have to do then is they have to allocate the income for the whole year between what portion of it was an S Corp and what portion of it was a C Corp, okay? And so what they're going to use is the number of days in each short year, which would be the daily method, or they could use the corporation's normal accounting rules to allocate income to the actual period in which it was earned. Not surprisingly, that's called the specific identification method. Okay. Now, so as you can imagine, what happens is that this termination of an S-corp status creates a problem for folks that have suspended losses. Okay, so let's look at this problem. So we've got Clampett Incorporated, and then they terminate its S election on August 28th, 2021. All right, at the end of the S Corporation's short tax year ending on August 28th, JD's stock basis and at-risk amounts were both zero, and he's never had debt basis, and he had a suspended loss of $20,000. Okay. In 2022, he made additional capital contributions of $5,000 on March 15th and $12,000 on September 20th. The question is, how much of this loss can he deduct in 2022? Now, it's important to recognize that in 2022, Clampett is not an S corporation any longer. Clampett is a C corporation, okay? But what we're looking at here is what's called a post-termination transition period. Okay, or PTTP, okay? And so essentially what this post-termination transition period does is give you a grace period, okay? So what you can do is shareholders can treat suspended losses that are existing at the S corporation's termination date, okay, to the extent that they have contributed capital, all right, in this post termination period, okay? So in general, that post termination period begins the day after the last taxable day as an S corporation, and ends the later of 1 year after the last S corp election day, the last S corp day, or the due date for filing the return for the last year as an S corporation, including exclusions. Okay, so let's take a look at what that means to us. Okay, so what that means to us is we terminated our S election on August 28th, 2021. Okay, so as of August 29th, we start that PTTP, and that PTTP goes all the way up to September 15th. Well, I should say September 15th, 2022. This is all that PTTP, okay? So ends on the later of 1 year after the termination period, okay? So 1 year after the termination period would be August 29th, 2022, all right? Or September 15th, 2022, because when is an S corp tax return due? It's due on March 15th. When is the extension due? It's due September 15th, right? So What does that mean? If we contribute capital on March 15th, that would increase our at-risk amount during that PTTP period, and then we would be able to deduct a certain amount of that suspended loss. Okay, this $12,000 that we contributed was contributed too late because it wasn't contributed until September 20th. Okay, had we contributed this $12,000 sooner, before September 15th, then we would have been able to use more of our suspended losses. As it is, we get to deduct in 2022, even though we are no longer an S corporation, we get to deduct $5,000 of that suspended loss because of our $5,000 contribution on March 15th. All right, so this problem is all about a distribution, okay? And so let's look at what we got. So we've got, at the beginning of 2021, we know his basis in his S corporation stock is $1,000, and he has a $10,000 debt basis associated with the $10,000 loan he made. In 2021, his share of the S corporation income is $4,000, and he received a $7,000 distribution. How much total income does he report in 2021 from these transactions? Okay, when you're looking at an S corporation and distributions, you have to consider two situations. One, the S corporation has been an S corporation its entire life and it wasn't ever a C corporation, or this is an S corporation that was a C corporation and has accumulated earnings and profits from when it was a C corporation. Okay? If it's an S corporation that doesn't have accumulated earnings and profits, then the rules on operating distributions are very, very similar to those for partnerships. Okay, so in this situation, we have no C Corp accumulated earnings and profits. Okay, because we're not told we have any, and that would be absolutely information that would be included if we had them. Okay, so now what do we have to do? We have to look at what was distributed versus what his stock basis is. So look at stock basis versus distribution amount. Okay, so let's figure out what our stock basis is. All right, so what was our beginning basis? Our beginning basis was $1,000. Okay, so remember, this $10,000, that's debt basis, that's not stock basis. Okay, so we have to keep those separate in an S corporation. So we had S corporation income of $4,000. Okay, so that's an increase in basis for ordinary income. So that's a $5,000 basis. And what was our distribution? Our distribution was 7. Okay. And our basis, adjusted basis, was 5. So then, as a result of that distribution, we're going to have $2,000 of capital gain because our distribution was larger than our stock basis. So we have $2,000 of capital gain, and we had $4,000 of ordinary income. So what does that do for us from a total income perspective? So from a total income perspective, we have $6,000. Okay? All right, so now we have another S corporation that has been an S corporation since its inception. On July 15th, the corporation distributed $50,000 to JD. His basis on January 1st was $30,000, and he was allocated $10,000 of ordinary income and no separately stated items. So the question is, what is his basis in his stock at the end of 2022? All right, so beginning basis was, what was it? His basis on January 1st was $30,000. And his share of the income was $10,000. So that's a $40,000 basis. What was the distribution? So his distribution was $50,000. So what does that leave his ending basis? Is 0. Because remember, ending basis cannot be less than 0, right? So none of these choices are correct because his ending basis is 0. Okay? And that is the last one of those types of problems. Now we're going to go to the next kind of category of material, and this has to do with the differences between self-employment income, salaries, and fringe benefits. Okay, so let's talk about self-employment income first, all right, because this is a big difference between S corporations and partnerships. Okay, so obviously when we talk about self-employment income, that's really not applicable to C corporations. Okay, the interesting thing is that S corporation income is not self-employment income. Okay, with partnerships and LLCs, remember, depending on the partner status, it might be self-employment income, okay? But for S corporations, it is not considered self-employment income. Can you pay a salary to owners? Yes, for C corporations. Yes, for S corporations. But remember, with partnerships, salary type payments are not called salaries. They're called guaranteed payments, and they're subject to self-employment tax, okay? Fringe benefits. Fringe benefits are not taxable to owners, okay? Fringe benefits are taxable if you own more than 2% of the stock, okay? And with partnerships, you cannot pay non-taxable fringe benefits to owners, all right? So we've got some significant differences in self-employment, salaries, and fringe benefits between different entities. All right, and so for this problem, it really should have been up in the previous category, but that's okay. It's still a good problem. So we've got Clampett Incorporated again. They've been an S corporation since their inception. So, all right. So they distributed $50,000 again. His basis on January 1st was $30,000. He was allocated $10,000 of ordinary income and no separately stated items. So now the question is, what is the total amount of income that he recognizes in 2022? Okay, so let's figure that out. So obviously he was allocated $10,000 of ordinary income, so we know he's got $10,000 of ordinary income, okay? But is there a tax impact as a result of this distribution? Okay, so we know that his basis, his beginning basis, was $30,000. We know that he was allocated $10,000 of ordinary income, so his ending basis is $40,000. We know that he got a distribution of $50,000, but his basis was only $40,000. So he had $10,000 of capital gain. So his total income as a result is $10,000 of ordinary income and $10,000 of capital gains. So that is a total of $20,000. All right, so I didn't notice that one of our distractors got chopped off, but I can help with that. So the question is, which of the following is not a true statement? Okay, and so not a true statement. So let's look at A. For shareholder employees who own 2% or less of the entity, the S corporation gets a tax deduction for qualifying fringe benefits, and the benefits are not taxable to the employee. So A is correct. Okay, that is a true statement. A is a true statement. All right, let's look at B. For shareholder employees who own more than 2% of the S corporation, the S corporation gets a tax deduction, but the otherwise qualifying fringe benefits are taxable to the shareholder employees who own more than 2%. That is also absolutely correct. All right. C says S corporation owners who also work for the S corporation have a tax incentive to pay themselves a low salary. That is also true. Okay. D should say an S corporation shareholder's allocable share of ordinary business income or loss is not classified as self-employment income for tax purposes. That is also true. Okay. E would have been the correct answer, and E said none of the choices are false. So E should have been the correct answer had I not chopped them off when I converted this to a PDF. So I apologize for that. All right, so now we're switching sections again, and we're talking about operating distributions. Okay, so we know that operating distributions are taxable as dividends to the extent of earnings and profits. Typically, they're not taxable to the extent of an owner's basis for an S corporation. Same as with a partnership, okay? From an entity perspective, the C corporation will have a gain on the distribution of appreciated property and no loss on depreciated property, okay? S corporations are the same as C corporations in this regard, all right? Remember, our partnerships, typically, there was no gain or loss on the distribution of property, all right? What about liquidating distributions? Corporations and shareholders generally recognize gain or loss on distributions. S corps, again, are the same as C corporations. Okay? Remember, partnerships and partners typically did not recognize gains or losses on liquidating distributions. Okay? So in this regard, S corporations behave like C corporations. All right? So let's do some problems. All right, so again, we've got Clampett, this S corporation, which was previously a C corporation. Under general rules, what order are the distributions deemed to be paid? Okay, so this is just one of those things that you have to remember, right? And so typically what we're looking at is D is the correct answer. Okay, so if you have an S corporation that was previously a C corporation, distributions come from the AAA account first, then the earnings and profits, and then the shareholders' remaining stock basis. Okay. Obviously, if you were never a C corporation, you do not have a AAA account or earnings and profits. All right, so now we have a problem that has a AAA account and earnings and profits. All right, so let's talk about what we've got. So at the beginning of the year, Clampett Incorporated had $100,000 in its AAA account and $60,000 of earnings and profits. Okay, during the year, they earned $50,000 of ordinary income and paid $200,000 in distributions to its shareholders. JD owns 25% of Clampett. His basis at the beginning of the year is $30,000, and his share of the distribution was $50,000. How much, if any, of the distribution is taxable as a dividend? All right, so we need to know how much is taxable as a dividend, okay? So remember that when you're dealing with an S corporation that had previously been a C corporation, distributions come first from the AAA account, then from earnings and profits, and then from his basis, okay? If they come out of earnings and profits, they are going to be taxed as a dividend. Okay, so what we have to do is figure out what portion of this distribution came from AAA and what portion came from earnings and profits. All right, so the beginning AAA is $100,000. Now, in those notes that I posted, there's a whole list of things that change the AAA balance, okay? Separately stated income and gain items, ordinary income, these things increase the AAA account. So we had $50,000 of ordinary income. So its end AAA account was $150,000, okay? So what that means is $150,000 of the distribution came from that AAA account. So the distribution, I'm going to change colors here. Was $200,000. Minus $150 from AAA. So then you have $50,000 that comes from earnings and profit, okay? And what comes out of earnings and profit is going to be taxed as a dividend. Now, remember, okay, so we know that $50,000 of that distribution is taxed as earnings and profits, but remember that JD is a 25% owner. So JD has that times 0.25, which is equal to $12,500. So for JD, $12,500 of that distribution is taxed as a dividend. Okay. All right, and now we're in this final section. Okay. So, and it's classified as entity level taxes. All right. And obviously we know that C corporations have entity level taxes because they have a corporate tax rate, right? Partnerships and LLCs do not have an entity level tax, but S corporations are this interesting entity because typically they don't have an entity level tax, but if they had been a C corporation, then they could have a built-in gains tax, they could have an excessive passive income tax, or a LIFO recapture tax if they had been a C corporation before they were an S corporation. All right, so this is the final problem for this whole set. Which of the following income items from an S corporation is not considered investment income for the purposes of the net investment income tax? Okay, and so let's look at our options. We've got passive income, we've got investment interest income, we've got dividends, we've got short-term capital gains. Okay, guess what? All of those things are considered investment income for the purposes of the net investment income tax. So E is your answer. All right, so I hope this video and all of these multiple choice problems are helpful. Check out the notes that I've posted. I'm also posting practice problems, so there are a ton of Chapter 11 resources posted. Thanks a lot.